Coffee Break with BBA, Fresh Brew 3, presented by BankingBook Analytics.
Hi, Blake. Welcome to Coffee Break with BBA. Folks, my name is Sohail Farooq, and today I have the pleasure of welcoming Blake to our Coffee Break with BBA episode number 3. Blake, a very happy new year to you.
Happy New Year to you, and thanks for having me on.
You're welcome. As I mentioned earlier, the key objective of Coffee Break with BBA, Journey to the C-Suite, is to trace the career path of successful executives. This has two takeaways: giving back to the community, i.e., for the youth to emulate the footsteps, and knowledge transfer, from learning from peers, their experiences, and really sort of, applying the practical approaches to solving real world problems, which is quite different from what we learn at school. So with that as the ingoing theme of Coffee Break with BBA, are you ready for a set of Q&A from our side?
Yeah, of course.
Good. Perfect. So tell us a little bit about the career path that you ended up choosing in securitization, derivatives, and credit products, and what sort of was a catalyst for you to choose this career path?
Yeah, great question. And full disclosure, I'm not on the C-suite at this point. I'm happy with my career, but not officially in that bucket. So my career path, it's definitely where I wanted to go, into the credit derivatives side of the business. I was always interested in math, physics, but also finance and business. So it's one of the math heavier focuses in the business field. I never particularly was interested in mortgages, but it is a large component of the credit sector in Canada, interest rate exposure in Canada. So it's a pretty natural progression.
Mm-hmm.
I entered the workforce, just to date myself, in 2008. Which was not a good time to enter the workforce. There's obviously a lot more supply of labor than there was demand. I had a couple of jobs fall through. So for the first few years, there's a lot of sacrifices, taking jobs that I knew would get me to where I wanted to go, as opposed to having a salary that was what I expected, or having a role that was exactly like I expected, working more in the operational middle office for one or two quick jobs. So I'm lucky to found a role that I'm really a career path that I'm passionate about.
Very good.
But I had that long-term view that this is where I want to go, and kind of staying on that path really helped.
Very good. Now, you've held many positions at several high-profile institutions such as CIBC World Markets, Central One, and now you're at Nesto. Tell us a little bit about the role that these institutions play in terms of orchestrating the demand for securitization products. For example, the role that Central One plays within the credit union world in terms of generating and creating liquidity. Throw a little bit of light on that, for our audience to understand what role Central One plays.
Well, and I no longer am with Central One, so I can't speak on their behalf. But I can talk about a bit of what I did when I was at Central One. It's a really unique institution. It's owned by the credit unions. Its goal is really to provide services to credit unions that credit unions on their own couldn't accomplish. So by working together and partnering, they're able to have top end capital market services, technology services. And so I guess just for background, I was at CIBC about 7 years ago. I was able to see the market. I was able to see what the other big banks were doing. I kind of came up with I knew what should be done at Central One. I didn't know about the credit union system. I didn't know about Central One, but I could see there was an opportunity. And I spoke with the team at Central One, and they were they're very open about giving me that opportunity. It was a lot of great mentors who gave me an opportunity at that time to really start and develop the business. They had a few basic functions like creating mortgage-backed securities, farm mortgages, buying those mortgage-backed securities and then selling them into the CMB, which are all ways of bringing cash in from capital markets and giving them back to credit unions. So
Exactly.
in my time there, what I was able to do is start creating a lot more programs. We created a swap program that let our credit unions access those capital markets directly. We added on asset-backed commercial paper. I think we were averaging about one new program a year. And basically our whole function was we wanted to bring all these tools to credit unions to allow them to access funding and liquidity using their insured mortgages as collateral and going out and raising this money. If you look at a bank, their rating is so high, it's easy for them to go to any investor and print a bond and get attractive funding. They have multiple sources of funding. A credit union is much more limited.
Yes.
In that capacity, but securitization is one of those products where, because you have insured mortgages backing the product, the investor sees it as very secure, and they can be on the same level playing field as a big bank when it comes to raising funding.
It's a very interesting perspective. I've also dealt with the warehousing and securitization, and in fact, the structuring of some of the loan products. And they were, of course, not insured loan products. So tell us a little bit about different type of analytical tools that you would use to analyze both the insured loan products and uninsured loan products.
Yeah, there's a lot of different things that go into properly pricing a mortgage. It's a pretty simple product, and I think a lot of the banks just have deposits to fund it against. So it's often seen as a fairly simple asset. But depending on how it's going to be funded, the properties, like if it's insured, obviously the credit risk is fairly low, but there still is credit risk that needs to be understood. I think the first tool we'd always use is to build out a cash flow timeline and then stress that. And then over time, I think you get an appreciation for what is the liquidity of a mortgage. So we often think of a mortgage as just a loan that sits on the balance sheet, but through securitization, you can actually fund that mortgage. So it now has liquidity. If a financial institution needs to bring in a lot of cash quickly, like a lot thought they would need to in this past year due to the crisis or the pandemic, they can use those insured mortgages to fund themselves. The same is not true for uninsured mortgages. So you have some liquidity risk there whenever you're lending between the two. In terms of the credit components, insured are obviously insured, so there's very little credit risk. On the uninsured side, you have two components: the probability of default and the loss given default in that case. And an important thing that I always talk about for understanding the uninsured mortgage product is that it's really a trade-off between what's the return you're getting on the interest rate for that mortgage compared to the loss scenarios. You can have a mortgage that's seen as much more risky, but given the return that it's bringing in, your margin over the long run is going to be much more attractive than a less risky mortgage that doesn't have the same return attributes. So, I think anyone who says I'm only going to look at risky mortgages, or high credit mortgages or low credit mortgages, is missing out on the overall big picture of how to run a mortgage book. I think you have to look at the return, look at your default probabilities, and then take a view on what's the best way to manage your overall portfolio.
Very good. Now, at a more macro level, if you look at the Canadian securitization market, what's the split that exists between the insured mortgages and uninsured mortgages?
Right now, we've been living in the insured mortgage market for securitization. I think there's a few uninsured mortgage programs, which is not unique to Canada, but it's definitely a feature for the Canadian securitization industry that is often talked about in our sector. Everyone knows we want to get to an uninsured mortgage securitization market. There's been some great deals. A lot of institutions have led the way in issuing RMBS, creating a market. but we're still really not there yet. It's not a common enough a funding option to have an uninsured residential mortgage backed security. The insured programs are run by CMHC. They're great programs, really attractive funding. I think everyone's utilizing them to as much as they can now. But the entire market knows we need to develop new solutions. If you think about the percentage of mortgages that went from being insured or insurable to uninsurable since 2016, I think there's a lot of data out there in terms of the actual numbers, but it's probably a third of the overall market, roughly.
Very good.
So that's been a major change.
Fantastic. All right, so we finish off with a crystal ball question. So 2020 has been one of the most complicated and challenging year for not just the Canadian businesses, but the global businesses due to the pandemic. What opportunities and challenges do you see in 2021?
Well, 2020 was a good year for learning, understanding markets a little bit better. I know there was times where basically we saw the market was not trading very, high liquid HQLA bonds that everyone assumed would always be available. We saw CMHC step in with some great programs that introduced liquidity into the market and I think are underappreciated. And I think it was a good year for everyone to test their models and their assumptions on risk and how liquidity actually works. 2021 will be an interesting year. I think there'll be, based on how the next few months go, there'll either be a lot more cash floating around, which will pour into the bond markets and drive yields down, and there's going to be a lot of competition there'll be very tight spreads, very tight margin, and in the mortgage side it'll be difficult to really maintain margins. I think overall, in a longer term trend, there'll be a lot more efficiency in capital markets. There'll be a lot more efficiency in mortgage markets. I think there's, fintechs and my current employer would fall into the fintech sector. I think those that are driven by not just applying technology, but applying efficiencies, taking out costs and introducing just a lot of common sense, best business practices into the market are going to do really well and are going to change a lot of what we see in the Canadian industry across both mortgages and capital markets.
Do you see inflation featuring in 2021?
That's a difficult question. I think it all depends on how you measure inflation. I know house prices. If you use that as some kind of benchmark in your inflation, then that's going to have quite a big impact. Costs of living are increasing significantly, just not in the inflation measure. So I have no crystal ball in terms of inflation. You'd probably have a better view than I do on that one.
Well, we'll have to leave it at that. Thank you so much, Blake, for making the time and really sharing your thoughts, your expertise, and your intellectual capital with the rest of the community. As I said earlier, this is our outreach initiative, really, where we think that we are contributing towards these young, youthful, up-and-coming graduates from business schools, from universities, and from science programs who are aspiring to join different forms of careers and are really looking into some examples so that they can learn more. Thank you so much once again. I wish you a happy 2021 and look forward to connecting with you professionally through 2021. Take care.
Great.
And bye-bye.
Thank you.
Yeah, thank you.